Hel- Hello, guys and gals. I'm Desi Arnaz, professional investor, and I want to welcome you guys today to our live. This is our episode. This is our current episode of the Invest Brilliantly broadcast, and I'm glad you guys are here. Today, I'm going to be carrying on in the discussion about a family banking dynasty trust. I've been talking about it for the last 2 weeks. Today is going to be part three of that series. And I'm hoping that you guys are going to get some real value out of this. I'm looking forward to sharing this information with you. And and I feel really confident that after you really understand how this family banking dynasty trust thing works, you're going to you'll want to create one for your family. At least I believe that's the way it'll go down for you. You'll want your family to benefit from something like this because it's a pretty powerful tool that's now going to be available in your toolbox. I guess we can call it, huh? In your personal investment toolbox. So I don't. Let's see here. I don't actually see here how to share my screen in this particular broadcast. And so what I'm going to do is I'm just going to kind of talk with you guys a bit. Screen share. All right. So let me share my screen and let's kind of move this thing forward. Let me get you guys started on this. All right. Yeah, here it is. I figured it out without my producer today. Unfortunately, my producer had other commitments and he could not be here with me today. But as I said, this is the Invest Brilliantly broadcast. We come here every Thursday at 2:30 Pacific, and we talk about things that are brilliant investments. And today, we're going to be talking about, as I said, the third part of our four-part series. And we're going to take a look up to this point. We've already taken of two of America's greatest businessmen, right? Cornelius Vanderbilt and John D. Rockefeller. We learned that the Vanderbilt built fortune was squandered by the very next generation of heirs, right? And that happens a lot when people leave an inheritance. The next generation was squandered, but the Rockefellers, on the other hand, their fortune was not squandered, and there's a reason for that. The Rockefeller fortune has survived now for more than 6 generations. We also learned that the Rockefellers implemented three strategies that virtually guaranteed that not only would their fortune survive, but also it would grow and it would not create a bunch of entitled trust fund babies, so to speak, right? But also that the family would grow closer together and the members of the family would understand and honor their obligations to share not just their wealth, but also their time and their talents and their benefit and the talents to benefit society. That's kind of what John D. Rockefeller wanted from his family. So today we're going to take a look at how the most financially successful families transfer their wealth from generation to generation, and they do it guaranteed and they do it tax free. And we're also going to take a look at how these wealthy families create a private family bank to fund their purchases and their investments. Now, if you're new with us, you may not know that our sponsor every week is the NoteinvestorUniversity.com. NoteinvestorUniversity.com. So you can head over to NoteinvestorUniversity.com and you can learn these financial strategies that we talk about here and many others. You can learn about setting up a family bank. You can learn about dynasty trusts. And you can become a part of a community of investors that meet regularly Saturdays via Zoom for networking and coaching and doing deals. That's what we meet to do. So you can become a part of that community. Just head over to noteinvestoruniversity.com. We'll see you over there. Now, as I mentioned a few minutes ago, today we're going to take a look at how the most financially successful families transfer their wealth intergenerationally, guaranteed and tax-free, and how these families also create a private family bank to fund their purchases and their investments. And the strategy is super simple, and it's available to every one of us. As a matter of fact, When I discovered what this strategy is, my reaction was, duh, how obvious is this? But in addition to transferring their wealth, this powerful strategy is also used to build wealth within the family and also to fund the family bank. This powerful strategy that I'm talking about is life insurance. That's right, life insurance. Now, I don't sell life insurance, so don't think I'm giving you some pitch because I'm trying to sell something. I don't have life insurance to sell you. But I have purchased policies like I'm going to be showing you here today, and I'm using the strategy that I'm going to show you here today, and it involves life insurance of all things. Okay? Think about this. Life insurance guarantees that your family is going to receive transfers that money, wealth, tax free. And it's a perfect way to transfer your wealth. There is a caveat. One thing that you need to look out for, and this is an important one, you can't just buy life insurance. There's a kind of life insurance that I'm suggesting is different. Yet, if you just go to your brother-in-law who sells life insurance, right? You need to structure it properly. You need to buy the right kind of policy. It needs to be from the right companies, certain companies that have certain characteristics. And we're going to talk about all of that here today. So you may want to take out a notepad because this is going to be really powerful, life-changing information. So let's take a look at the type and the structure of the life insurance that you should use to grow your wealth and to transfer to fund your family bank. Okay? The engine for driving this wealth is a machine. I'm sorry, the engine for driving this wealth building machine is a whole life insurance policy. Okay? Whole life policy. But it has to be structured properly so that it can serve as a holding place, a sort of repository holding your cash. That's the foundation of a family. So what does that look like? Well, to begin with, what you want to do is you want to create your dynasty trust. We talked about that last week and how to do that. So you may want to go back if you haven't watched last week's episode, go back and watch that, and you'll learn how to create your dynasty trust. So trust has been created. Then here's what you need to do next. What you want to do is you want to identify a mutual life insurance company to buy this life insurance from. Now, I recommend that you try to find a company that has a 100-year track record of paying dividends, and that is a mutual company. You only want to deal with mutual companies like Penn Mutual, something like that, Mass Mutual. It should have mutual in the name because you want to deal with a mutual company. The reason that you want to deal with a mutual company is because when you buy life insurance from a mutual company, you are a shareholder automatically within that company, and you get to share in the profits of that company in the form of dividends that are paid to you every year. And so, what you're looking for when you're looking for a company to get your insurance through, you want a company that has 100 years or more track record of paying dividends every single year, even through the Great Depression of the 20s, even through the Great Recession of 2008, they still pay dividends. And so those are the companies that you want to do business with. All right, that's the first thing I want to tell you. The second thing is you want to purchase a whole life insurance policy from these people. But you don't just want the insurance agent to write the policy in the way they want to write it. You need it written in a specific fashion. And here's what that is. You want to have the minimum death benefit. You're not trying to maximize your death benefit with these policies. Now, what I discovered, and I've since come to understand, is that most insurance agents don't want to write the policies this way. And it's very simple, the reason they don't want to. They get paid on death benefit. So what they want you to do is they want you to buy as much death benefit as possible. That's what they want you to do. And you want to buy the minimum amount of death benefit as possible. So you guys are automatically at odds unless you're working with an insurance agent that's very familiar with this strategy and has purchased into this strategy. In other words, they bought into this strategy and this is how they do business. And which is, by the way, Only about 1% of the insurance agents out there do this. So the odds of your brother-in-law being that one in that 1% are pretty slim. So keep that in mind before you get on the phone and start calling your family members or your friends and saying, "Hey, I know you sell insurance. Sell me some mutual insurance." They're going to fight you on this. I know that from personal experience because I went to a friend life insurance for a long time, and I told him I wanted to do this, and he was fighting me every step of the way. As a matter of fact, we didn't really talk to each other anymore as a result of that. I know what I wanted, and what I wanted was minimum death benefit. I'm going to show you why that's important in just a couple minutes. Second thing I want is I want the ability to add something called paid up additions, P to the policy. Paid up additions, basically little mini insurance policies that you can add to your main insurance policies. It's like a little add-on, okay? And you can add on these paid up additions um, often. And so I want to have that flexibility. The third thing is I want to have the ability to add a term insurance policy rider to the policy. So those are three things that you need to have. By having these financial instruments, um, so you're going to have the capabilities to make deposits and withdrawals just like any other bank, right? You'll be able to put money in, take it out, to use it. Because obviously, when we put money into a bank, some of it we may want to leave there, but some of it we need to use to pay our bills, right? To buy groceries. So, same thing here. When you create your family bank, you want to have access to that money so that you can use it when you need it. But when you're not using it, you want it sitting here. And so, once you've done this, you've got your policy in place, policy to your Dynasty trust. It's a simple thing to do. You literally fill out a little one-page document. You send it to the insurance company and you say, okay, I want to change the owner of the policy from me to the trust. And they'll change the owner of the policy. That's it. Okay. You'll still be the beneficiary of the trust. So you'll still be the person that benefits from the death benefit and all that, and your family will, but you won't be the owner of the policy. So that's the second thing you need to do. Now, now that your policy has been created, let's create a family bank. How do you do that? We start by depositing your savings and your paycheck and any money that you get into your family banking system. And you do that by sending it to the insurance company instead of sending it to Bank of America to your checking account, right? Right now, when you get paid, you probably take that money, put it into your checking account or your savings account, and then you use that money to pay your bills. Well, before you do that, or even after you do that, what you want to do is take it out of your Bank of America account. If you put it in there first, like let's say your check gets deposited there automatically by your employer, you take it out of there, send it over to the insurance company, and I'll show you why in a minute. But you send it over to the insurance company, and they're going to put it into your one of your two accounts that you'll have with your insurance company. You're going to have two accounts with them. One cash account where you can put money in, take money out, put it in, take it out. Is your legacy account, which is going to be kind of think of it like a long-term savings, right? We're going to talk about that too. You are already depositing your money into your bank accounts. We all do. So all I'm simply saying is one more step, and it's going to change everything for yourself and your family for the rest of your lives. Okay? So let's move on here. Traditional banks typically offer you a checking account and savings account, right? They typically offer you one of those two types of accounts. Well, here, your family bank is going to have two types of accounts. As I just said, you're going to have a cash account, which, by the way, is an interest earning savings account, which you can withdraw the money from anytime you want to. Okay? So it's a cash account. It's a place to park your money instead of leaving your money sitting in your checking and your savings account at some commercial bank. You leave your money sitting in your own bank, and it's earning interest while it sits there because you put it into a mutual life insurance company account, and they pay you interest. Right now, for example, I'm earning about 5% of my money that's sitting there, and that's not even with me investing it. It's just sitting there. Okay. If I need to invest it, I can take it out and go buy real estate and go buy whatever, right? Because I like to buy real estate and real estate related assets. But right now, if it's just sitting there, I'm still earning money. So that's the first type of account. The second type of account is a legacy account. Now, this is the account that's going to go to your family members when you die, right? So it's kind of like a forced savings account that's going to pass on. But there's good news that I want to tell you about this. You never withdraw money from this account. Never. Let it continue to grow. Okay? This is a long term savings and it's going to pass on from generation to generation. But here's the powerful thing: every time you deposit money into this account, the insurance company will not only match it, they will 3x it, or 5x it, or 10x it. They will give you credit for $2 or $5 or $10. The longer you have the account, the more they give you credit for. And that's the really cool thing about this type of account. You're going to see an actual example of that in just a couple minutes. Okay. So the other thing about this account, this is you can use this long-term legacy account for tax-free retirement income for yourself when you reach retirement age, if you'd like to. You can certainly use it to transfer your wealth to your heirs tax-free. You can use it for major medical expenses that might come up. You can use it to invest in other things. So it's a really powerful way to create your accounts and to set up your own family bank. So now, why park your money in a family bank? Here's why I think you should park your money into a family bank. Because every deposit that you make into your family bank account is split between your cash account and your legacy. Now, how the split is set up, you get to decide. For example, you can say, hey, I want 90% of the money to go into my cash account and 10% to go into my legacy account. I want 50-50. You get to decide how you want that money split up. And um, either way, though, you will have access to all the money that's in your cash account whenever you need it. Okay, so keep that in mind. And so if you know what your needs are, you can split it this way. The beautiful thing, though, for example, if you did a 90-10 split, you say 90% of my money of the deposit that I make, I want to go into my cash account, and you deposit $1,000, you could go immediately. You can take out $900 of that to go and do whatever you need to. So it's not like you're tying up this money. Before I found out about this type of structure, it really be anti-life insurance. And the reason that I was is because my thinking on it was, hey, I need that money now. I can't be paying for life insurance, too much life insurance, because it's taking away from the money that I need today to pay things today. But once I realized, okay, all right, and buy life insurance for myself and for my family, and still use the money. Now that's a game changer for me. That was a major eye opener and game changer. And I hope you just caught that nugget. You can have life insurance, which guarantees a legacy, a financial legacy for your family, and still use the money to do other things. So that was really important to me since I'm an investor. And so if I'm putting my money into something that I can't get at when I want to make an investment, that won't work. But in this space, I can put my money into these policies, and when I find something I want to invest in, I literally just pull out the money, go make my investment, and now in my life insurance bank, I'm earning 5% on that money that was in there, even though I took it out. And I'll explain that in just a minute. But yes, I'm still earning 5% on that money that I put in there. I'm still earning dividends in there, but I've taken the money out and I'm using it to go and buy some real estate. So I'm earning in both spots. I'm earning on the real estate, assuming I buy right? If I make a stupid investment in real estate, I can lose money. But assuming I know what I'm doing, I buy a piece of real estate, I'm making money there, and on the same money, I'm making money inside my family bank. Wow. That's why this thing grows your wealth so quickly. So here's the strategy. When you put money into your cash account, so you put in $1,000 and you say, I want 900 of it to go into my cash account. Now, by the way, you can say you want 500 to go into your cash account. It's up to you. You decide. Okay. I want 900 to go into my cash account and I want 100 to go in my legacy account. So once you put money into your cash account, it starts earning that interest and dividends, here's my advice: never take it out. Even though you could, never take it out. Never. Just let it keep growing, because then you get the effects of compounding, right? That money starts to earn interest, and then that interest starts to earn interest, and then that interest starts to earn interest, and so you start to earn. Your money is earning interest, your interest is earning interest, and that interest and that interest and that interest are all earning interest. So your money grows really fast inside that cash account, and that's why I say just leave it there. So then you may be asking, well, Desi, if I you just said earlier I can take the 900 out if I needed to invest. Well, here's what you do. You don't take it out of that account when you want to invest. When you want to invest, here's what I do, and here's what I suggest you do. You borrow it from your legacy account, because your legacy account is not even going to be used until you die, right? That money's just going to be sitting there until you die. So you borrow your legacy account, then you pay it back to your legacy account. That way, the money that you have in your cash account is still getting interest and still earning and growing and growing and growing. And that's going to be important over time. And when I show you an actual case study of an insurance policy that I purchased on my granddaughter, then you'll get it, right? It'll make sense to you. So the strategy is you never withdraw from your cash account because you want that money to compound. Over time, what will happen is the interest that you're earning on your cash account will actually pay for the insurance policy, so that you don't have to ever, and no one ever has to pay an insurance premium again. You heard me right. You'll pay for the insurance for a few years, but after that, nobody has to pay for the insurance. But yet you still have this legacy, this financial legacy that is growing and growing and growing, and it is um, being paid for. Is self-funding. It's funding itself, because you're earning so much interest on the money that you have in your cash account. It's just a powerful, incredibly powerful strategy. So, okay, so you access your money by borrowing from the legacy account. Now, here's the beautiful thing about borrowing from your own bank. You get to decide the repayment terms. You get to decide the interest rate. You get to decide if you even pay the money back at all. It's up to you. It's your bank. Now, I like to pay the money back, and I like to pay it back with interest. My thinking is this. Look, if I borrowed that money from Bank of America, I'd have to pay them back with interest. So if I borrow it from Bank of Desi, right, why not pay myself back with interest? Just treat it the same way. And when I do that, I'm actually creating even more of a financial legacy for my family. And after I pay it back, if I need it again, it's in my own bank. I can go get it back again if I get, you know what I mean? Versus if I borrowed that money from Bank of America and then I paid them back, I can't just go get it again. They may not give it to me. They may say, hey, you don't qualify for financing for a loan from us anymore. But we don't do that kind of loan anymore, because that money is now in their bank. And so what I'm simply saying is I pay myself back, and I pay myself back with interest, the same as I pay any other institution. But that's a choice. You don't have to do that. I just want you to understand. Okay? It's a choice. But it's a powerful, powerful strategy, isn't it? So I promised you guys a case study. So let me show you a case study of one of my grandchildren. This is an actual policy that I purchased on one of my grandchildren. And any of you guys can do this. Okay? Any of you can do this. It's very. She was 5 years old when I purchased this, which was like 3 years ago or so now. All right? And I knew that I could budget to put $3,000 per year into a policy for her. It's $250 a month. Okay? I knew that I could budget that, especially considering I knew that if I needed that $3,000, I could take back a chunk of it. So I set up her policy so that I believe I set this up as let's see here, 85. I set this up as an 80-20. Remember I said I get to decide whether I want 90% to go to the cash account and 10% to go into the legacy, or if I want 50% and 50%. I set it up so that 80% of the premium goes, I'm sorry, 80% of the deposit that I make into every time I make a deposit, 80% of that deposit goes into the cash account and starts to earn interest and dividends. 20% goes into the legacy account. And as I said, in the legacy account, the insurance company when you put money into the legacy account, the insurance company X's, 5X's, 10X's, 20X's, whatever amount you put in there. So here's how it works for the first one. Okay. So let me show you guys this here. There's two different types. There's guaranteed returns and then there's non-guaranteed returns. Now, I just want you to understand the non-guaranteed returns are the historical returns. And remember I said we only work with companies that have been around for at least 100 years? They have a track record. And they are required to share with you what their historical track record has been. Okay? And so even though it's not guaranteed, this is what we've been doing for the last 100 years. Okay, may not be guaranteed like the guarantee section there, but the odds are pretty darn high. They've been doing it for 100 years. They're probably going to keep on doing it that way, right? I mean, it's just kind of common sense. So we're going to be looking at the non-guaranteed returns. By the way, I can tell you now I'm in my third year on my policies, and I am seeing the non-guaranteed returns, which is well beyond the guaranteed returns, okay? So I'm just telling you the reality of it from the policies that I have personally purchased. All right, so let me show you how this works. This is really cool, okay? So I purchased this policy for my granddaughter, right? I agreed to pay $3,000 a year. Now, some of you guys are probably saying I can't budget $3,000 a year. That's okay. $1,000 is available for me to take time I need it, okay? See right here? I can take out $2,477 if I needed it. $2,477 is available to me if I needed it out of that account. So it's not like I paid $3,000 and it's gone. If something comes up, I can. So I just want you guys to really get that. Okay. So that's how much cash I have available. But look at this. Look at my legacy account. Now, this is my legacy. Die the next day. My family's $3,000. They're going to get $175,000. Right? In this case here, it's not my policy, but if my granddaughter were to pass away, I hate saying that. But if that were to happen, then the trust that we have, this insurance policy inside, would receive $175,000. So that's we get some examples of this as we move through this. Okay? So that's the first year. Let's look at year 4. And by the way, when you look over here, you'll see this is how many years the policies have been in effect. This is the age of my granddaughter year after year, okay? So here we are, we're looking at year 4. I paid $3,000 in on year 4. I deposited $3,000 into this account in year 4, okay? And look what happens here. Up as 80-20. Remember I said I want 3,000 to go into cash account? Look how much they put into my cash account. I deposited $3,000. They credited my cash account with $3,032 in year 4. Isn't that interesting? Okay, but there's still money that went into my legacy account too, because look what has happened to my legacy account. Well, I didn't show you the legacy account yet. I'll get to that here in just a second. Okay, but here's what I did. Now I said I'm willing to pay $3,000 per year into the deposit $3,000 per year into this account for 7 years. After that, I said I don't want to deposit any more money. I don't want to make those kinds of deposits. I only want to deposit. In my case, I chose $453 a year, not a month, a year into this policy. $453 a year. It's a little more than $1 a day, okay, into this policy after the 7th year. So let's look at year 8. So year 8, I deposit $453 into my cash account. And take a look what they give me credit for. They give me credit for $1,576 in that cash account, even though I only deposited $453. I need to let that sink in, because I can tell you right now, if I deposit $453 into my Chase bank account, they don't credit my account with $1,500. They don't. They give me credit for $453. That's it. This is a very, very important point to make about having your own family bank. Okay? Remember, I said because of dividends and interest, you're actually that money given to you as well. So I deposit $453 and my bank deposits the difference to make it the total $1,576. Didn't come out of my pocket. Okay? That is powerful. Look at this. The legacy account also grew. Remember, in year one, the legacy account had a $175,000 balance, but by year eight, there's $244,000 in the legacy account. Okay? So think about that for just a minute. I'm going to just, okay, there we go. Looks like my producer is back. Um, so I want you guys to see that because that's pretty huge. That's pretty huge. Even though I'm only depositing $453. Let's take a look here. Let's go down to when my granddaughter turns 30 years old. See here, she turns 30 years old at this point. So this account is now 25 years old. Let's see how it works out for her. I'm depositing $3 into this account, but yet they're giving me credit for $3,597 in that account, in my cash account. That is crazy. And by the way, I don't even have to deposit $453 because way up here, right? Like for example, in year four, out of this $1,500, let me just go back. Out of this $1,500 here in year four, I could have said to the insurance company, I'm not going to put $453 in there next year. Just take it out of the $1,500, and they would just take it out of the $1,500 and pay the next year, and then they would do the same thing the next year because every year they're giving me $1,500, then look $1,600, $1,700, $1,800, $1,900, $2,000. They're giving me credit for in my cash account, so I don't even ever have to pay for this insurance again, starting in year eight, and maybe even a little bit that because when I look here, I am depositing $3,000, but they're giving me over $3,000 credit right here. So I could literally say next year I'm not going to deposit $3,000. Just take the $3,000 that you gave me an increase and deposit it here, and then that year they give me $3,600. And I could say the same thing again, or I could put in half of it. It's up to me because it's my bank and I'm making deposits. Okay? So I just want you guys to get that. So let me get on back down through here again and just show you something else. So this is her at age 30. I'm going to continue to deposit personally because I can easily put $400 a year away, right? Like I said, it's a little more than $1 a day. I will continue to pay that because then this policy grows even faster, right? The bank account grows even faster. So in year 30, I deposit $453 for $3,597. $3,500. That's like almost 10x of what I put in. That's powerful. Now, look at the legacy account. The legacy account has now grown to a third of $1,000,000. The legacy account has grown to a third of $1,000,000, $330,000 into the family trust if something happens this year. That's really incredible. But take a look here? Have I deposited anywhere near $300,000 in this account? No way. No way. As a matter of fact, take a look right here too. There's $66,000 in my cash account right here. This is the total amount of money in my cash account. There's $66,000 in my cash account. I haven't even deposited $30,000. If you add all these up right here, I haven't even made a $30,000 deposit over all those years. However, there's $66,000 available in my cash account because the interest and dividends just keep adding up. See how powerful that is? Now let's just take a look here when my granddaughter reaches age 65. When she turns 65, right? That's when most people like to try to retire. So when she turns 65, again, we put $453 that year into the account. And look what they credit the account with. The account gets credited with $20,800, even though we only deposited $453. we get access to $20,000 additional dollars. Look how much money is available right now for my granddaughter if she, by then I'm assuming I'm gone, right? But look how much money is available. If my granddaughter needs to access some cash at age 65, there would be $422,000 in that account that she could access through the trust. If something happens to my granddaughter right around that age, then $757,000 will be paid to the trust, which all of my kids will have access to. Okay? But look at the cash account. That's really incredible. The cash account is $422,000. We haven't deposited anywhere near $400,000. We've only been putting in $453 a year, right? So we haven't put in anywhere near $422,000, but yet that's how much money is in our account. Guys, this is incredibly powerful. Now, let's just say that my granddaughter lives to be age 90, and this will be the last of the example. Let's say she lives to be age 90. Take a look at this. She'll deposit $453 into the account, just like every year, but they're going to increase the account balance by $52,000. Imagine that. Put $453 in your, and they credit your account with $52,000 that you can use. Access to it anytime you want. You can even withdraw it if you want. But as I said at the beginning of this, don't withdraw it. That's why we don't withdraw it. We want it to continue to grow. Look at this. Our legacy account is now all the way up to $1.5 million. So when my granddaughter passes, this trust will inherit $1.5 million for her kids and her grandkids to have access to. $1.5 million. This is how you keep the family forged and moving forward, right? But look how much cash at age 90 have access to. At age 90, she'll have access to $1.3 million in cash. In cash, if she wanted to pull it out. She can pull it out. She can pull it out, she can borrow it, she can do whatever she wants to do with it. In cash. Have you ever seen anything so powerful? This is way better than me putting that $3,000 a year for 7 years into Bank of America. I could put $3,000 a year for 7 years into Bank of America and then put $453 a month into Bank of America. I would have nothing near $1.3 million in cash. I certainly would not have $1.5 million in death benefit that passes on to my heirs. You see how the wealthy think? You see how the wealthy think? This is why I say, getting rich is not an accident, and staying rich is not an accident. It takes financial intelligence. So here's what I decided to do, and if you like this idea, certainly. I decided to insure every family member that I have, right? So initially, I think I bought 21 or 22 policies. I recently let one of my nephews in to the trust. So it'd be him and his wife and his 2 children. We're now putting policies on them, right? And so they'll have access to the funds in the trust if they want to buy a car. Because what we do is the money that's in the trust, and I'm going to show you guys this next week, the money that's in the trust, the cash that is the trust, and the combine of all the policies, that, let's say someone says, hey, I need a down payment for, you can take, some money out of the trust. Or if they want to have down payment for a house. FHA or VA or Bank of America, they can just and make mortgage payments back to the trust. Right? And that's how this stuff works. And that keeps the money in the family. I love that part of it because most of us pay our bills and the money leaves our house and leaves our family and we never see it again. Right? Like when you pay Lisa, the money's gone. You never see it again. When you pay your money into your family trust, paying back your own family bank, that money is there. The next time you need it, or if one of your other family members needs it, it's there. How powerful is that? That's incredible, isn't it? Incredible. What we do is in our family bank is the beneficiary, our family trust, our Dynasty trust is the beneficiary of all the life insurance policies and the owner of life insurance policies as well. You don't have to set it up that way. That's just how I set mine up. Okay? And when someone dies in our family, the trust is going to give that person's survivors, their estate, their heirs, some of the money that the trust received from the life insurance policies. We're going to give them some of that money so that they can bury their loved one. I don't know about in your family, but I remember many times in my family getting calls from family members that Uncle Mike died or whatever, and we're taking up a collection so we can bury him. We can have a funeral, right? And so all the family members kick in a little money to try to help make sure Uncle Mike gets a good send off, right? Well, with this type of structure, if Uncle Mike is a part of the trust, he's going to get a good send off because he's going to get part of the death benefit. And by the way, Uncle Mike didn't have to pay a dime to be a part of this trust. None of my family members pay these premiums. I pay all of these premiums because I can make a $3,000 premium payment, for example, on my granddaughter. Then I can take $2,400 out of that and make a $2,000 premium payment on my grandson. And then I can take $1,600 out of that and make a $1,500 premium payment on my next. And it's the same $3,000. You guys see that? It's the same $3,000 that I'm using to buy each policy. So you don't need a lot of money. And by the way, I chose $3,000 a year. I could have chosen $200 a year, if that's all I could budget. That's why I said any of you guys can afford this. You can afford $200 a year. That's not even $1 a day. It's like 70 cents a day. You can afford that to cover somebody and start this process. Here's the key thing about building a family bank. Somebody has to start the process. Otherwise, your family is going to be struggling generation after generation, people living from paycheck to paycheck, people worrying about money, and it just doesn't make sense. And you don't have to do that. The last thing I want to tell you guys about this here is the way that I set mine up is I set mine up so that people from my family can borrow money from this trust. They just have to pay it back with a little interest, which they are all glad to do. And my family members are using this like crazy. They're using it, and I really am happy to see that. But we also give grants because I want to pass along my values. I'm a Christian, and I want to pass along my values. And so I actually put clauses in my trust that says if one of my heirs, children, grandchildren, whatever, attends a Christian school, they can get tuition assistance. They don't have to pay it back. They can get tuition assistance from the trust. I just want them to have that. The other thing that I put into my trust is that every year, every family member will get a certain amount of cash from the trust. Every adult family member will get a certain amount of cash from the family trust. It could be 5,000, it could be 10,000, it could be 20,000. It just depends on how much money is in the trust. I worked out a formula to say, okay, based upon how much money is in the trust, obviously we don't want to drain all the money out of the trust, so we divide it up amongst all of the family members that meet certain criteria. Now, the need to attend our annual family reunion. I put that in there because I want my family to be closer together. So we've already done it the first 2 years. We've got another one coming up this year. It brings us together from all over the country once a year so we can bond even more. So many families today are all spread out all over the country and they start to lose touch with each other. And I didn't want that in my family. And so the family members that want to be able to take advantage of these annual distributions of just free money coming from the trust, they need to show up to the family reunions. Okay? That's something that I put in there. And that's because I want my family together. Maybe that's not important to you. Then you don't put that into your trust. But the beautiful thing about setting this up is you can decide what is important to you and what is of value, and you can build that into your trust. And any family member that wants to benefit from your trust has to abide by those rules. The other thing that we did is we put together a family council that's comprised of 5 senior family members that are wise family members. And so when family members start to have disputes, their disputes need to be settled by, if they're part of the trust, their disputes need to be settled by our family council members. And they all have to abide by the ruling of the family council. Into my trust. I hope you guys found this stuff here really and eye-opening. Understanding this, your family bank is your bank. Okay, you set it up, you control it, you get to decide what it's going to be like. Okay, you set it up, you control it, you decide. So next week, I'm going to show you guys some practical uses for using your family bank. Okay, so show up next week, bring a friend, bring a family, and let me show you guys how you can use your family bank. For example, how to get out of debt. How would you like to pay off your house in the next 5 to 7 years? Pay off all your debt. Right? You can do that using the systems that I'm going to be showing you guys next next Thursday at 2:30 p.m. Um, West West Coast time. Okay. Look, guys, this is really a great thing. You may be thinking, well, my money's not. I don't have cash available. Well, you have your savings in a retirement account. My money was in an IRA. I decided to close down my IRA and take my money out of it and use that money to start these policies. So that's how I got started the first. That's how I got started the first year. Took it out of my IRA. I didn't have to take it out of my. I didn't have to shut down my IRA, but I did. I chose to do that because I feel like this is a way better way to place for me to put my money than inside a self-directed IRA. I can still use the money when I need it to go invest, which is what I do. But I'm earning money. I'm earning interest and dividends while it's sitting there inside my self-directed IRA. I don't earn anything while the money's just sitting there. I have to literally take it out and invest it in something to earn. Here, I earn while it sits, and it compounds, as you just saw. Okay? So that's why I thought, you know what? Even if I have to pay a little bit of a penalty or a tax to get the money out, I thought for me, which by the way I didn't have to do because I'm old, so you can take your money out without that. Okay, and I had a Roth IRA. So I didn't have to pay any tax because it was a Roth IRA, and I'm old, so I didn't have to pay any penalties. Once you get 59 and a half, you don't have to pay any penalties. You can take the money out. So anyway, I took my money out. But even if I had to pay penalties and taxes, I would have done it because I've already made up for whatever I would have lost there. And I'm only in the third year, and it only gets better year after year, as you saw. Year after year, it gets better and better and better. So the longer the policy is in place, the more you make, the more you earn. So thank you guys. As I said, head over to Note Investor University, our sponsor, noteinvestoruniversity.com, and you can learn these strategies there and other strategies because it's all about learning how to invest brilliantly. It's all about teaching you financial intelligence. So head over to noteinvestoruniversity.com. Check us out. We have a weekly mastermind group that meets every Saturday morning for usually an hour and a half, which you can participate in. We also have coaching, one-on-one coaching, group coaching, other things like that that you might want. Depends on where you want to go. But from wherever you are right now, we can take you to where you want to be if you are serious and you want to make something happen in your life. So head over to Note Investor University to learn more about that. So again, guys, I just want to say thank you guys so much for sharing this time with me today. I hope that you found value here today. And I trust that if this moved you, that you're going to take some action on this. Don't let this just be a good idea that you heard and say, wow, that's a good idea. Somebody should do that. No, you be that somebody, okay? You be the difference maker in your family. So that's our episode for today, guys. I just want to say God bless you. Again, I'm Desi Arnaz, professional investor, and I'll see you guys next week.